anyone who is interested in getting their ITR filed this year through Belong, where you will have CAs like Sagar, do it for you. You can visit the website and start the process, avail of the service. I'll be happy to talk about it a little bit more towards the end.
Let's start with the term NRI. I mean, NRI is the most widely used and misunderstood term as well. So I always start my session with defining what an NRI is, because, like the word doctor, which can mean different in different, parameters. Similarly, NRI also means different in different laws. So, for example, immigration law can mean something else. The FEMA law can mean something else, and income tax law, of course, everybody knows, is dependent on the number of days how much you spend in India. So we should not consider NRI to be a generic term, and then if I am an NRI under one law, that one law defines me, so I am an NRI in other laws as well. That kind of perception should never be there. That's why I always start with this. So just like the word doctor, NRI is also a very generic term. We have to analyze it in different laws. So we'll start with FEMA, then we will move to income tax, and then we will take the details about NRI taxation matters. In fact, NRI as a term is not defined under FEMA at all. FEMA only talks about a person resident in India and a person resident outside India. And the rule is similar to how income tax is, but this is just a residual rule. And it talks about more than 182 days. So there is a subtle difference between income tax and FEMA. Income tax says that 182 days or more in a financial year, whereas FEMA talks about more than 182 days, which means 183 days or more. But still, it is only a residual clause. The other, intention why you are going out of India really matters to define whether you are a non-resident or not. By that meaning, person resident in India or person resident outside India. So, for example, even on 31st March, if you take up employment abroad and leave on 31st March, you become a person resident outside India from day one. Similarly, if you're a spouse going with your husband or wife for employment abroad, which means that your intention is to stay for indefinite period, again, you are a person resident outside India from the same day. So, doesn't matter even if 364 days you have been in India, but on that particular day, that is, in our same example, 31st March, you become a person resident outside India. And then there are other definitions also, like if you take up any business outside India, or for enrolling in any educational institutes abroad. So from that particular day, you become a person resident outside India. And how does it matter? It matters because all the transactions that you would be eligible to do otherwise as a resident would not apply to you. I mean, there are certain restrictions or certain limits under which you can play cross-border money movement. That applies to you the moment you become a person resident outside India. That's why this classification is very important. Now, who runs the show for FEMA? It is the RBI as well as the central government. So there are various agencies of the central government which also can influence a lot of notifications under FEMA. And the RBI issues all the notification circulars and all. The policing is done by ED, which is the Central Enforcement Directorate. And the execution is done by our last mile contact banks. So any bank which has AD license, AD is an authorized dealer license under FEMA. That bank is authorized to operate in foreign exchange and deal with NRI kind of business. So, the banks are the last point of contact which check whether your transactions are properly going through as defined under FEMA or not. That is why, banks may ask you a lot of questions or KYC documents, or whenever you are repatriating funds, they may ask you certain forms like 15 CSCB to be submitted, because they have been authorized by RBI to check the FEMA compliance. So I like to use this analogy that, FEMA is like a traffic signal, and so it will define whether the signal is green, red. Green meaning, you're allowed to do any transaction. Red is prohibited transactions, and orange being restricted with certain limits, that kind of transaction. So FEMA will define every transaction under 3 categories, whether you're allowed to do that or not. And when you cross that signal and you reach to the other end, there is a toll plaza over there, which is the Income Tax Act. The toll plaza will never ask you how you reach there. You may have broken certain signals. You can still arrive there. For example, NRI can still maintain a saving account, which is a non-compliance under FEMA. But because he is maintaining a saving account doesn't mean that he shouldn't file his income tax return. So once he reaches to the toll booth, he has to look at, what is the tax applicable to him and file the tax. Because non-compliance under one law should not be construed to be doing a non-compliance in other. And the other way around is also, if you are paying income tax in India, doesn't mean that you are FEMA compliant. So still there may be certain mistakes that you have committed under FEMA. And just because you paid Indian government the tax doesn't mean that, FEMA gets regularized. For example, the same one, saving accounts being maintained by NRIs, that is a non-compliance under FEMA. Just because you are filing your returns and paying taxes does not regularize this transaction. Now let's come to the Income Tax Act. Income Tax Act, as I said, is the toll plaza at the other end. It will classify every person in 3 lanes. One is a resident, which is ROR. Second is a resident, but not ordinarily resident, which is RNOR. And third is NRI. The basic purpose of this classification is to check how much slice of income can be taxed in India. So for example, a resident and ordinarily resident, just like me, who stays in India for most part of the year, has to pay tax on my global income. Whatever I earn overseas also, even if I have got shares abroad, I will have to pay tax in India. Now, the other is RNOR. In the case of RNOR, if there is any business being actively managed and operated from India, that will also be taxed. Apart from that, global income is not taxed. And the third category is NRI. Now, how do they classify it? Is purely arithmetic based. It's based on the number of days you stayed in India in the last financial year. So this is always a historic calculation. So, while filing our return of income for the last financial year, we go back and check how many days we were in India, and that determines our residential status. And based on that, everything is determined, like what will be taxed, what source of income will be taxed in India. So the first criteria is if you stay in India for 182 days or more, or stay for 60 days or more this year, and more than 365 days in the last 4 years, then you become a resident. So once you are a resident, again, you have to check whether you are an ordinary resident or not ordinary resident. So if you have to qualify as a not ordinary resident, you have to be a NRI in last 9 out of 10 financial years, or be in India for less than 729 days in the last 7 years. 7 years being the year before this financial year, which we are assessing. So there is this particular exemption to citizens of India who are living India for jobs abroad. For them, there is a relaxation that this 60 days limit is removed. And if you stay in India for 182 days or more and stay in India for 365 days in the last 4 years, then only you qualify as a resident. And the third criteria is for returning NRIs who are citizens or PIOs of India who are coming back to India. For them, if they stay in India for 120 to 181 days in the first year when they are coming, and their Indian income is more than 15 lakh rupees, then they become a RNOR. So it's a slightly complicated calculation how your residential status is determined. It is not only based on the number of days, but here, if you see 15 lakh rupees of Indian income in the financial year also matters. So it is based on the number of days you spend in India historically, plus how much is your income in India. So that's how they classify. And once they classify, as I told you, a resident has to pay tax on global income. RNOR pays only tax on Indian income plus any business which is being operated from India. And NRI pays tax only on the Indian income, Indian sourced income. I'll quickly summarize the difference between income tax and FEMA now. So income tax is a revenue law which will look at how much they should tax you. Whereas FEMA is a regulatory law. It will determine what all things you are allowed to do or not. For example, once you surrender Indian passport for taking another passport, you may have applied for OCI, but in the meanwhile, when you surrender your passport, you become a PIO by default, and a PIO is not allowed to buy property in India. So such things are all determined under the FEMA law. So we have to look at FEMA law every time you want to do any transaction, which will be cross-border transactions. Second point was the residential status that we have already covered. It depends on more of, purpose why you are going outside India under FEMA. Whereas in Income Tax Act, it depends on a lot of factors like how many days you stayed, what is the Indian income, all these things. Again, the residential status for income tax can be only one during a financial year because you check it historically at the end of the year, how many days you were in India, and then you classify as a ROR, RNOR or NRI. Whereas under FEMA, every time you move in and out of India, based on your intention, this can change. So your residential status as per FEMA can be different for different part of the year as well. And the purpose of classifying your residential status under income tax is just to identify what portion is taxed in India, what assets or what income should you disclose in India. Whereas under FEMA, it is generic, like, what all things can you do permission based. Once you determine the status, what has to be taxed in India and all, then India classifies the income in 5 broad categories: income from salary, income from house property, which is basically rent. It is not only restricted to house property, it can be commercial property as well. Then there are capital gains, which includes all the capital assets. So capital asset is also defined under Income Tax Act, and whatever is defined as a capital asset falls under the capital gains. Then income from business or profession. And the last residual clause is the income from other sources, which includes interest, dividend, and all. So we have to classify the income under these 5 categories. How it is classified, what is included in these categories, everything is defined in the law. And based on that, the tax rates also may change. For example, for capital gains, there are special rates of taxes. Long-term capital gains, for property held more than 2 years, it's 12.5% plus surcharge and cess. Then short-term capital gain can be on slab rate. Again, this example is only for property. But for other asset classes, the table is vast, it's very wide. There are different tax rates. And particularly last year, from 23rd July 2024, after the budget, a lot of changes happened. So mid-year also the tax rates have changed. So there is a table up to 22nd July if your sale happens till that date, and from 23rd July onwards, if the sale of any capital asset happens, then there is a separate tax rate. So it's slightly complicated for the last financial year. Then rental income for NRIs, it's completely taxed in India. There is, compliance to be done on every rupee being paid to you. The TDS should also be offered. We will come to the TDS slide in the next one. But rental income is taxed in India. Salary would be taxed only if you are a ROR providing, the same example of a US person coming back to India. If he classifies as a ROR, then his global salary may be taxed. Otherwise, only if the services are performed in India, only then for NRIs, salary would be taxed in India. Otherwise, it won't be taxed. Then in terms of interest and all, NRO interest is taxable in India. NRE interest or FCNR interest is completely exempt. It is good to show it under your exempt income category in the ITR. The business or profession, if it is set up and being operated from India, then only it is taxed in India in case of NRIs. Otherwise, it is not. Now, after you do all the calculation, you find out your gross total income. Then if the income is more than 1 crore rupees, then there is additional compliance, which is a Schedule AL, which is basically kind of a balance sheet, which gives you certain broad level of assets and liabilities where you have to disclose your Indian assets and Indian liabilities only. That is only for NRIs, you have to disclose only Indian assets and Indian liabilities. The Schedule FA, which applies to a ROR, which is a resident and ordinarily resident, which is a very detailed schedule which has to show all your global assets, all global, signatories, wherever you are signatory to any of the accounts, or you are maintaining any insurance contracts or whatever, even if you're a nominee to certain contracts, everything has to be reported under Schedule FA, but that does not apply to a NRI or RNOR. It only applies to a ROR. So even if you are filing returns in India just for compliance perspective or just to maintain regularity, there is no harm because you are not disclosing your global assets. You are not paying tax on your global income. The only thing is, if you are filing returns in India, you have that regularity that you are showing to the Indian income tax authorities that how many days you stayed in India. So you are maintaining that track record with them. So, just because you are filing returns in India does not expose you to a lot of global taxes and all, because anyway, you are not disclosing the Schedule FA, which applies to us, a resident and ordinary resident only. What are the disclosure norms in income tax return? As I said, the foreign assets don't have to be disclosed. Only the Indian assets have to be disclosed. Now, all the bank accounts have to be mandatorily shown, which include your NRE, NRO, FCNR accounts also, since they are held with Indian banks. Everything has to be disclosed. If you have any dormant accounts which you have forgotten also now, and you have not been operating it for more than 3 years, then you can leave it. But if you know the IFSC code and the bank account number, then it's a good thing to disclose all the bank accounts, because not mentioning your bank account is also considered to be a non-compliance. So it's better to disclose all your bank accounts. Then you have to select and designate one of your account. Ideally, it should be an NRO account, for taking refunds if you have any refund from the income tax department. Ideally, it should be a NRO account, but if you don't have an NRO account, then you can designate a saving account. You can never give a NRE account because in NRE account only foreign credits can come in.
Ankur, if you are there, Vivek is asking, is Gift City a good jurisdiction for investment from and to India for an NRI based out of the US?
I think for investing into India, it is emerging as one of the best ways for NRIs to invest their foreign income into India. And couple of reasons we discussed for that last time was there are certain fund structures that are completely exempt from TDS or tax on capital gains on the India side. So that is one of the benefits, and also you don't have to route your investments through NRE or NRO accounts. You can do it directly from your US bank account. It remains fully repatriable. So these are some of the benefits, and that's one of the reasons that it is becoming a preferred way to invest. So but currently, again, one of the limitations is that there are only AIFs available to invest in India, which has a high ticket size of 150,000 US dollars. But yeah, in the upcoming months, there are already retail mutual funds with much lower ticket size of say 1,000 to 10,000 that are already in the works and should be launched soon. So once that happens, that becomes a more efficient way to invest in India.
Harshul Shah is asking, can NRI invest on Gift City funds via NRO account within USD 1 million limit?
That is possible. So once within that 1 million limit, obviously you will have to do some compliances like filing 15 CA, CB and all of that. But after that, you can take it out of India. It becomes repatriable and you can use it to invest.
From Nilesh Sahu, what should be the best way to channel foreign savings to India for NRIs planning to return to India to avoid taxation?
I mean, I can give 2 points and then maybe Sagar can take it. So first of all, just because you're moving your savings from one country to other country doesn't become taxable, right? Like if you can show that okay, this is from your US account where you have already paid taxes, and then you're just moving it to your NRE account, right? So that does not make that income taxable in India. Tax has already been paid. So that's the first thing. The second thing is the RNOR status that Sagar brought up earlier. So that's like a transient status where a returning NRI can get a sort of breathing space of 1 or 2 years where their global income is not going to be taxable. So that can be efficiently used to lower your tax when you are moving assets from one country to another. These are just two like sort of broad rules of thumb. Obviously, it requires a fair bit of planning if you want to really minimize it. But yeah, I mean, Sagar, feel free to add more nuances to it.
Yeah, I mean, that's all. Your capital is not taxed because it's already taxpayer money. RNR status is there, which is a transitionary stage available to NRIs to balance all their assets and all. And if there is any complex scenario, then we can always have a one-to-one session and discuss what all other ways can be there. But legally, as per the Indian Income Tax Act, these are the only two ways available. Apart from that, structuring them may be a possibility that we have to check. But that structure has to be made overseas. So this section 195 applies to all NRIs, which says that any income being paid to you has to go through the TDS route only. So except for the exempt income, like NRE interest or FCNR interest or life insurance policy, which is within the 1010D threshold, like ULIP policy below 2.5 lakhs and all. Apart from that, if you are getting any income which is in the nature of income, like any payment in the nature of income, the TDS has to be deducted on such payments, which means even for your rental income, your tenant is supposed to deduct TDS. The compliances have to be done. Like TDS rate is for the slab rate income, the TDS rate is very high, which is 30% plus cess of 4%, which is 31.2%. So 31.2% TDS has to be deducted on your rental income also, irrespective of the threshold. It can be 1,000 rupee also. But then the tenant has to do all these compliances. Then he has to take a TAN number, deposit the TDS on your behalf, and file a quarterly return as well to show that the payment has been made under this PAN. So it's a very lengthy process, but unfortunately that's the law. So any payment being made to NRI has to only go through this TDS route if it is in the nature of income. Of course, gifts from your parents or relatives are not covered here. But I wanted to cover this up that under Section 195, it's very stringent. Now, this specifically matters because when you sell a property in India as an NRI, the TDS rate applies to the entire property proceeds. So the entire sale consideration, TDS has to be deducted. The rates are as per the capital gain rates, which are 12.5% plus cess plus surcharge, which can go up to 13% for if the property is sold for below 50 lakh rupees, and if it is higher than 1 crore, then it goes to 14.95%. So the entire sale consideration, on that a TDS is blocked. The buyer has to deduct TDS. He has to deposit it to the government, and you can claim it back by filing a return at the end of the year. If you don't want to block your cash flow, then there is a way. You can apply to the jurisdictional assessing officer, who is your ITO. You can apply to him, fill a form 13, take the printout of all these set that this is the transaction that I'm going to undertake. And based on that, you can take a lower tax deduction certificate from him. But that is all a manual process. So, you need to plan ahead at least 2 months in advance if you need this certificate from the income tax department. Now, who should file the return? It's not only about whether you are liable to file a return in India or not. Of course, you are liable if you have a special rate income, because there is no minimum exemption limit for special rate income like capital gains and all. Even if you have capital gains of, let's say, 2 lakh rupees, which is below 2.5 lakh limit, but still you have to file a return and show that income, because obviously there will be other incomes as well, interest and all. So, you will have to file a return in India. Then if your income is only rent and interest, or, slab rate income, which is the general income, then up to 2.5 lakh rupees, if you have the income, then you don't have to file return in India. But it is always advisable to file to show that your calculation of the number of days you stayed in India, that is an opportunity to show to the income tax department that you stayed in India for so many days. So it is a good practice to keep filing returns in India. Also, for your home country, they may ask you certain documents in the future, like the source of income, or proof of whatever income you have been generating in India. So this becomes a very good trail for you. So having a regularity of filing returns in India is a very good practice. Then, of course, there are other benefits of getting visas or taking bank loans in India. For taking a bank loan in India, even if you are buying a property, they need your income tax returns. And for NRIs, filing backdated returns becomes a problem because they don't have any other income in India. And once you miss this deadline of 31st December, you cannot go back and file a return as well, unless you want to pay more taxes. So it all gets too complicated if you don't have a regularity in India. Which forms should you use? You cannot use ITR-1 form, which is only for resident Indians, and ITR-4 also cannot be used. So for NRIs, ITR-2 is the form if you don't have any business income. And if you have business income, then ITR-3 is applicable to you. Business income can also mean, intraday activities or F&O trades and all. Because of that, they get classified under the income from business. So because of that, also ITR-3 may apply to you. So these are the two forms which can apply. The revised deadline is 15th September this year. It's not 31st July. So what happens if you miss filing your return by 15th September? You can still file by 31st December. You will have to pay a late fee. Late fee depends on how much is your total income. If it is more than 5 lakh, then 5,000. If it is lesser than that, then 1,000 rupees. Then if there is a tax liability, then interest may also apply under different sections, like have you paid on the advance tax basis or not. So based on that, interest can also get attracted. But 31st December is the last window to file. If you don't file by then, you cannot claim any refunds. Generally, in case of NRIs, the TDS is very high and they usually claim a lot of refunds. So 31st December is the last opportunity that is available to you for any financial year. Now, this special facility has been introduced. It has been extended rather now for up to 4 years. This is if you miss reporting any income and if you want to come forward and pay taxes on that, if you want to clear your tax records, then you can still after the end of assessment year, within 4 years, you can come forward and file your returns. So for example, the last financial year was 24-25. The assessment year for that is AY 25-26. And now you get an opportunity up to 4 years, which is 31st March 2030. Till that time, you can come forward and file the return for this last financial year, only in case if there is a tax liability. So if you feel you have missed reporting anything, you can go come forward, pay tax. But when you go and file under this section, there is a tax on tax. So basically, this additional tax liability is on your entire tax amount. This is a surcharge which is being imposed. So this is kind of a penal tax which you need to pay if you want to clear your past records. You can also reduce your tax liabilities with DTAA. India has double taxation avoidance agreements with all major countries, around 85 to 90. Now you can claim double taxation benefit. This is basically a treaty between two countries which says that what portion of income will be taxed in one country and what won't be taxed, or how we are going to give credit between two countries. So if a citizen of UK comes to India, then how will his income be taxed in UK versus India? Everything is given in this treaty. So there are different, treaties, different wordings in every treaty. There are certain benefits also available. For example, India UAE treaty says that for capital gains, it has given 5 different asset classes, and there is a residual clause which says that anything not mentioned here will be taxed in the home country, wherever the tax resident is staying. Now, considering that terminology, you can take the benefit that since there are no taxes in UAE and mutual fund are under a residual clause, you can potentially pay 0 taxes on mutual fund income in India, irrespective of whether the investment is made through NRE, NRO, or while you were a resident and now moved out of India and all. So, that kind of benefits are also available under a DTAA. And then there are reduced taxes, or how the taxation would work for overlap in any particular year. That all is mentioned in this DTA agreement.
So a lot of NRIs, that we have seen, assume that DTA means that it will be taxed only in one country, which is not the case, right? DTA just means that the same income will not be fully taxed in both countries, right? So at the base level, generally, while it is taxable in both countries, you can avail of the tax credit that you have paid in one country in the other country. Generally, you will end up paying tax at the higher of the two, some in one country, some in another country. But don't just assume that because you have paid tax in India, it doesn't, it means that it's not taxable in US or vice versa.
So here are some of the key pitfalls. Wrong residential status. This is a very common mistake which I've seen amongst a lot of NRIs. They say that, since I'm maintaining savings account, let me file as a resident Indian. Show the income under a presumptive basis, which is only allowed for residents, and pay only tax under the presumptive mechanism and all. But the moment you declare yourself to be a person resident in India, I mean a ROR under the Income Tax Act, then Schedule FA gets triggered, which is the schedule of foreign assets, and your global income becomes taxable in India. So, don't commit this mistake of miscalculating or showing something just to make it convenient. Then I've included this, that AISTS has to be checked properly. Any sort of exempt income, since it gets hit to your bank account, you should report it under the exempt income category. Last year, we saw a lot of notices coming for the NRE interest and FCNR interest also. So it is a good practice to keep reflecting exempt income also in your returns. Then agricultural land or farmhouses or any agricultural related property or business is not allowed to be held by a non-resident NRI. So that can be an Indian passport holder, OCI holder, or a PIO. Nobody is allowed to invest in agricultural property in India. You have to be very careful about this. The only way you can acquire them is through inheritance. Apart from that, there are certain limits. If you are taking any gifts from your relatives, or if you're lending to any of your friends in India, there are certain restrictions. There are some regulations which you need to follow. There is a LRS, which is the liberalized remittance scheme. So any resident in India, let's say your parents can send money to you, but only up to $2.5 lakh per PAN per year. It cannot be split in different accounts or anything. It has to be in different PAN. So the limit applies per PAN. So let's say, one person cannot gift to two children $2.5 lakh. The limit is per PAN. So all these limits have to be properly checked and followed, because later on these notices are very draconian. And we have covered this also, that if you want to plan TDS, lower TDS certificate and all, you need ample time in hand to get the Section 197 certificate.
So as we have seen, like it can get quite complicated very quickly. So anyone who is looking for an expert like Sagar, to file their taxes this year, and now given that things are getting automated from the income tax department, a lot of notices are being triggered. It's always better to stay on the right side of compliance. So we'll be happy to assist them. We have experts like Sagar who will do the entire end-to-end filing for you. I think there's a QR code on the next slide which you can scan to go to the website. It's getbelong.com, and there you can just request our services, and an tax expert who is well versed with NRI tax laws will handle the entire process for you.